Happy Friday, ladies and gentlemen, and welcome back. I am your friendly neighborhood PM here to give you your top 3 market points of the week. Now, it has been a very eventful week in the market so far, but when is it not? So without further ado, let's dive right in. And at point number 3, it is Nike firing their current CEO, John Donahoe, and replacing him with longtime former exec Elliott Hill. Now, this is very, very important for Nike. The shares jumped almost 8% after the announcement. And this is because Nike has continued to falter this year, down close to 25% on their stock price, given that they have seen faltering sales, people not drift to their lifestyle brands like Nike Dunks or Jordans, and have been going to other competitors such as On Clouds, Hoka's, Adidas. So this is a bid to revitalize the brand, maybe get more people into their lifestyle brand products, as well as revitalizing their relationship with retail stores, which have continued to kind of dwindle over the last couple of years or so. At point number 2, it was retail sales exceeding expectations in the month of August. Now, this is very important because we have continued to see kind of a weakening of the consumer over the last couple of months, given how high interest rates have been, as well as inflationary pressures. But this past month, we saw increased activity driven primarily by e-commerce and online shopping. So this is very, very important because we're starting to continue to see a more resilient consumer going forward, even though household savings have kind of been drawn down as they've combated inflation. And this parlays perfectly into our first point, which is the Fed's rate decision that they just announced over this past week. So for those of you that weren't aware, didn't see it in the news, the Federal Reserve did cut interest rates by 50 basis points. Now, I said this is important for the consumer because, well, this lowers borrowing costs, this lowers financing costs, and that essentially increases purchasing power. Now, on the flip side of that, the Fed did leave themselves many options going forward. They didn't want to cut too much too soon, and they didn't want to tip their hand either going forward. So there was some optionality that they may issue additional cuts going forward throughout the rest of the year, or they could stay pat on what they've just done. Now, the federal funds rate is now at about 5%, still restrictive enough to where if inflation reaccelerates, that can help curb it a little bit. But on top of that, they have said that their focus is now kind of transitioning more to the labor market. And if they do see increased weakness and softening there, which we've started to see over the last couple months or so, they can then cut further throughout the end of the year. Now, this is going to be very important, so we're going to keep eyes on labor market data as well as pricing data every month, and you're probably going to get much more frequent updates on that going forward because monetary policy is a key driver in the markets right now. That does it for your top 3 points. What are we looking to for next week? Well, very similar, like I just said, pricing data. It's going to be core PCE data next week because this is one of the Fed's primary gauges of inflation that they like to keep an eye on. So we like to keep you updated when we get the chance. But as always, that's pretty much this week's video. And if you have further questions, please dig into the written week in review or reach out to your financial advisor. Otherwise, while the weather is still good, please go out and enjoy that weather this weekend. We will see you the same time next week. Thanks again. Bye.